talking today about the foreclosure process. Alicia had brought that topic up to me because according to her, a lot of you guys might have some questions about the foreclosure process. So we'll see how this conversation goes. We'll start with the foreclosure process itself, and then we can transition into any topic that you guys want to talk about as far as this goes. So how to get business from it, things to watch out for if your clients are really coming up onto being foreclosed on, what are some of the seller's rights out there, buyer's rights, that sort of thing. Jeff in the past, and I don't want to speak for him too much, but he has historically done a ton of work representing banks in foreclosure. So he knows the process really well. I don't think he does it too much anymore, but when Alicia had mentioned to me that this is a topic you guys wanted to talk about, I really thought that Jeff would be the perfect person to invite onto the call. So without further ado, Jeff, I want to introduce everybody to Jeff. Everybody on the call here, Jeff Formica. Everybody on the call here is from Keller Williams Showcase Properties. And tell us a little bit about yourself, my friend, and tell us about whatever you think we should know about the foreclosure process. He's not the smartest attorney, guys. He's not the smartest, but he is the best looking attorney. There we go.
Can you hear me now?
Now I can hear you, yes.
And I heard you, by the way.
Oh, you did?
I'm Jeff Formica from Creed and Formica. Nice to meet you guys, although I know I've met a number of you, definitely over the years. By the way, today is the firm's 28th anniversary. We started the firm, Jay and I, my partner Jay Creed, on September 1, 1992. So longer than some of you may have been alive. I don't know. By history, I actually started as a foreclosure paralegal and attorney in the late 80s and early 90s. All of my business was at one point just foreclosures. I worked for a law firm that no longer exists, but all I did every day was set up packages for the attorneys. Then when I became an attorney, I also did and conducted the foreclosures, on the lawns and in the hallways and so on and so forth. It's been many years since I've done them, but I'm still familiar with foreclosures. And the first thing I would say to folks who are not familiar with them is foreclosure is basically a two-step process. The first step, in most instances, properties are owned by an individual. The first step in the process is to determine whether someone is in the military. It used to be called the Soldiers and Sailors Civil Relief Act. It's now called the Service Members Relief Act. And the reason for that importance is it actually stems from the 1940s, from World War II. And the law still exists and has always existed in Massachusetts. The theory being, if you are out there on the front line, putting your life on the line and getting shot at, then the government ought to give you some sort of break if you are in the military and not foreclose. So especially during World War II and then the subsequent wars where we've had people go to war, the banks had to first determine whether or not someone was in the military. And if you were in the military, the foreclosure was stayed or held off. So the first step is to make that determination. And to make that determination, the actual homeowner has to be served or served by sheriff or left at last address. And then you go to court and you receive either through the land court or through the superior court a judgment which adjudicates you are not in foreclosure. That step alone will take anywhere from 30 to 60 days if you are on rapid fire, if you're an attorney who's really focused and has staffing to go and do the foreclosure on a fast-paced process. Second part is once you are determined you're not in the military, the foreclosed owner or the owner is not in the military, that's when the actual foreclosure process starts. So people think of foreclosure, it actually includes first the Soldiers and Sailors or the Service Members Civil Relief Act. And in order to do a foreclosure, the timelines are as such. Notice has to be given and published. No less than, it has to be published 3 times before the foreclosure date, with the first publication being no less than 21 days prior to auction. So once you've determined someone's in or not in the military, and if they're not in the military, you can go to foreclosure, you know you've got at least another 30 days, and it's usually another 30 or 60 days before the foreclosure auction itself will take place. Now, right now, and I don't know the current standing on it, right now there is a moratorium on foreclosures. We've seen this in the past, but due to COVID, there's a moratorium. And in the, frankly, it takes usually 90 days to 120 days for a bank to foreclose. When I used to do foreclosures, one of the pitches we used to give to the banks, I represented Fannie Mae and Freddie Mac directly. We used to have to fly out to Texas regularly, is we promised we would go to auction within 90 to 120 days. Because they wanted, back in the day, they wanted those foreclosures happening and happening quickly. They don't want to have those loans continue to default and payments not being made. So the process also can be delayed if the foreclosed owner files bankruptcy. Then the bank has to go in with the attorneys. We have to go into court and get something called relief from stay in bankruptcy. So anytime you're dealing with a foreclosure, or if you know someone who's in foreclosure, it's safe to say you're going to be, once they start getting the notices, 90 to 120 days away from auction. That being said, we are seeing banks, for better or for worse, sometimes take years to foreclose. You yourselves may know someone who's been in this situation. It's 2018, they're in trouble, and they're still not foreclosed on. And the problem, I think, with that is foreclosure, having been someone who used to conduct them, and I don't mean some, I mean tons, thousands. Foreclosure is like ripping off a Band-Aid for some people. Some people, if they're in over their head, you can only start repairing your credit once you are foreclosed upon. Bob, you'll know those guidelines better than I will, but I think it's 3 to 4 years, like a bankruptcy, 3 to 4 years before you really can start to think about buying a new home. 7 is what they say, but really 3 to 4 years. So if someone who's been in the foreclosure process for 2 or 3 years and the bank doesn't simply understand that technically they're not able to close and get title insurance, which is a huge risk. You would never buy the property in that instance. Now, I've closed them with the risk for my clients by taking exception. And the reason the title insurance companies are doing this, they're saying, listen, if the property's been foreclosed and the foreclosed owner or family member is still in that property, they feel that there's a high degree of risk that that foreclosure will be challenged by the foreclosed owner as a valid foreclosure or by the family member. And they're not willing to insure on that risk. They're not willing to insure until such time as a property has been vacated.
Hey, Jeff, is that state by state, and just because Massachusetts is really tenant, I guess, strong or whatever, or is that nationwide?
It's Massachusetts, not state by state. I actually don't know how the other states handle it. I just know that Massachusetts, in terms of landlord tenancy, is known to be the most difficult state. I'm not from Massachusetts, so I say this objectively. The most difficult state to evict, but also it is because over the past 10 years or more, there have been a lot of challenges against foreclosures, and there have been a lot of laws that will undo a foreclosure. So you think you have a perfectly clear title, a perfectly clear foreclosure, and all of a sudden there might be one I that wasn't dotted or one T that wasn't crossed, and now someone's challenging the validity of the title and the validity of the foreclosure. And in fact, as closing attorneys, it is a good idea now to actually submit your title or the relevant portions of it to the title insurance company to get their blessing to insure the property. They're looking for all of the proper affidavits, the affidavits by the lenders that they actually hold the note that the mortgage secures to be able to foreclose. There were a lot of things that were done over the last 10 years, 15 years that were very sloppy and caused major uproar in the foreclosure and titles. I will also tell you that anyone who you are representing as a buyer agent out there, Keller, who is buying a foreclosed property, they would be insane not to buy title insurance. It's insane. It's insane not to do it on a normal transaction, in my opinion, but on a foreclosed property, absolutely insane. We've actually seen, and there's cases called Pinty and so on, where Eaton, Pinty, where traditionally foreclosures that were always considered to be good and where people were closing on them day after day after day after day, all of a sudden a case law comes out that says, by the way, all those foreclosures are no good anymore. they're all invalid. If you have title, good luck. I mean, no joke, it's crazy. So you always want that title insurance because they're going to protect you on that.
Hey, Jeff,
But
and I'm sorry to keep cutting you off, but what about
yeah,
some seasoned foreclosures? You know, so let's say that my seller isn't in foreclosure, but you know, the people that they bought from in 2010, you know, it was a foreclosure.
yeah.
At that point, do you still recommend title insurance as strong as you do now?
That's a great question. First of all, I always recommend title insurance. Secondly, what you brought up, which I didn't think about, is when a bank forecloses, they actually do something called an entry. And this literally comes back from feudal times in England, where a landlord would make entry on land and literally break a twig. And that was a symbol that I'm now claiming that you were in default or that I'm going to take ownership of this land. So as part of a foreclosure process, the bank not only conducts the auction, but when on the day of auction, what they do is they make entry in front of two witnesses. There's always two witnesses there. And they say, I, Jeffrey Formica, attorney in fact for Wells Fargo or Bank of America, hereby make entry as concerns a certain mortgage from Jane and John, book page. And even if the foreclosure is bad, after 3 years, the entry perfects title in the bank. Now, of course, you have to have entry by the right bank. And believe it or not, that may sound crazy. So if you have a mortgage that goes to Radius and then Radius assigns it to Wells Fargo and Wells Fargo assigns it to Bank of America, if the entry is done by the wrong entity, the entry's bad too. Not only is it foreclosure, but the entry's bad. But usually they get that right. So if there's challenges in any other way, after about 1,000 days or 3 years, title will be perfected in that bank, and that bank who then deeded the property to the buyer, that's called an estoppel deed, will be retroactively effective. So that is one way that time does cure even defective foreclosures, but it's 3 years. And that's basically it. I wanted to describe for you guys today the process, the turn time. Secondly, why banks are just taking their time to foreclose, which is unfortunate, I think, for homeowners. You're better off to pull off the Band-Aid and just get it done. And then finally, the issue if the property is occupied by the foreclosed owner or a family member, that the property is uninsurable for closings. I hope that helped.
Yeah, no, thank you very much for that. I'm sure that a lot of us have questions here, but I just have a couple of questions for you, if you don't mind, and then we can open it up.
Yeah.
When in the foreclosure process, does someone lose the right to, does a homeowner lose the right to sell? So, you know, Trisha Daly here on the call, she has a listing. The person says, we're getting these notices. We have $100,000 in equity. We can't lose it. We can't make our payments. So let's sell ASAP. When does Trisha have to worry about, does my client or will my client on the day of closing 30 to 60 days from now have the power to sell?
So is Trisha representing the seller in that instance or the buyer? The seller? Yeah. So I think the seller needs to fess up and let Trisha know whether the auction occurred. What do I mean? So the auction, let's say property's going to foreclosure and there's an auction today. It's going to take the bank 30 or 90 days to actually record the foreclosure deed. So it's a kind of a gray area in this way. If the bank doesn't record the foreclosure deed, there's an argument that the foreclosure is not perfected. And if Trisha is selling the property for the seller, and we all know that as part of that closing, buyers or buyers lenders council is going to need to get a payoff letter. If the bank that foreclosed actually furnishes a payoff letter, you're pretty safe to say that that's okay. They're not going to perfect the foreclosure by recording the foreclosure deed, and the closing can go on. But if the bank says, oh, no, we're not going to furnish it. We foreclosed, we're going to perfect it, then there won't be a payoff letter and the closing won't happen anyway. So it's going to be really up to Trish and Trish's homeowner to find out, well, and the homeowner should know. They get notices, they get certified mail, they get notices if there's an extension. They should know whether or not it was foreclosed. I will also say this. You guys have mostly probably heard it. The law office of Mark Harmon does a lot of foreclosures. There's a couple of firms out there that just do most of the foreclosures these days. Jay and I used to work at a firm that was one of them. And they actually have websites where you can go and look on their site to see if a property has been foreclosed. So if there's a notice as to who's going to be doing the foreclosure work, which definitely Trisha's client knows, you often can go on those websites and see if the foreclosure is happening or if it's been postponed. If any of you have time, go on the Harmon website and you'll see there'll be a whole probably drop down, it used to be, as to foreclosures, and you'll see their month of foreclosure activity, and you might find that property as to whether or not it was foreclosed or was delayed or postponed. But if it has been actually foreclosed, if someone like a Jeff Formica went to the lawn and broke a twig, you got to be very cautious on saying that property is now available for sale.
Right. What and so I guess the last thing that I'll just mention, then we can open it up, or if Alicia has questions too. But Jeff mentioned earlier that sometimes foreclosures, it takes years for the foreclosure to happen. And one thing that we do see, we don't see it often, but just something that comes up often enough so that we have to make note of it, is one of the questions that every mortgage loan officer is going to ask of their clients is, have you had any bankruptcies or foreclosures in the last 7 years? A lot of times what people think about is, all right, so we were evicted from the property back in 2012. So now it's 2020, so it's been 8 years. So my answer is no, right? So I left the property in 2012. It's 8 years later, so the answer is no. It's really when that foreclosure, like Jeff said, right, was recorded. When did that actually go through? And maybe they were evicted from the property in 2012, but maybe that foreclosure didn't go through until 2014, 2015. So now they're only 5 or 6 years out of foreclosure, right? Through no fault of their own. I can show leases, from 2013, 2014, showing that I wasn't in the property at all, but they were still owners of that property. So that's just something that we literally just ran into last month, where a client had told us no foreclosures in the last 7 years. It turned out that August was the 7-year mark, so we really got lucky. She said to me, it was really, I was thinking about when we left the property, and it was like 2012 or something like that. So she had plenty of time, didn't even think about it because the house is in the past, but the paperwork didn't change until 2013, August. So we're outside of that 7 years now, so she's good to go. But that's another one of those things that's just, can muck some people up, so you just want to be really careful of that.
Bob, I have a question for you. If it's within 7 years, are they still financeable? Can you still do it?
Financeable, both conventionally and with FHA. Both have different terms and requirements, but typically I think 2 or 3 years will get you into one of those, FHA or conventional. And the one big thing about people that have a foreclosure in the past or have a bankruptcy in the past, lenders really want to see that they've turned over a new leaf, right? So lenders are going to be hypersensitive. If we're within that 7-year window, they'll still be hypersensitive on the borrower's ability to repay other debts. So if we start to see recent, 2 or 3 year late payments on credit cards, student loans, like a disregard for credit type, that could be something that turns an approval that we get through Fannie Mae or Freddie Mac or FHA into a manual downgrade to decline. So it's really just something that we have to be careful of.
And again, I know it's a broken record. That's why I find, having been someone who used to foreclose, but back in the day, banks foreclosed quickly. They wanted it quick. Fannie and Freddie that's foreclosed, put a new rug down, get some paint going, and get that property off the books. Now, with these banks dragging these things for 2 to 3 years, it just doesn't do a damn bit of good for the homeowner. It's really, if you're in trouble, you just want that. It's hard to lose your property, but once it happens, and I've seen people, I've coached people on this. Once you do lose the property, it's devastating until that happens. After that happens, most people sort of recover and realize, all right, this is done now. Let's move on. But when it takes 2 to 3 years for these banks to do it, and they do it for various reasons, it's just brutal for them. But that's what we're seeing a lot of right now. Now we're going to continue to see it because foreclosure is going to have a moratorium.
Yeah.
And Bob, you could also mention how you're seeing the people who are doing forbearances with their lenders, and how that, I don't know if you've had that discussion with this group, but how that can bite them in the butt.
Yeah, we haven't yet, but we definitely will, because there are ramifications of that for sure.
Yeah, there's nothing's for free out there, as they say, right?
True.
Everything.
Very true. Yeah, exactly right. Exactly.
Yeah.
So
Can you say something as to what forbearance is?
I can, Bob, can you? Or
Yeah.
I'll give you it. So it's basically the lender saying, it's okay. We know you're having a tough time right now. You don't have to pay us right now. You have to pay us later. And those forbearances can be reported, Bob, right? And then that actually, now Fannie and Freddie have a problem lending on those situations where there's a forbearance. And some people we see applying for them and don't even do them, and now they've got to explain it. So Bob, I'll let you carry on in that, because I know you're probably seeing some of that.
Yeah, so basically middle of March, COVID was spreading rapid. The COVID wave was coming through Europe, and knew that it was, we knew that it was going to hit the United States. It was just a matter of time, right? And so the federal government came out unannounced and just rolled out this forbearance plan that through Fannie Mae, Freddie Mac, and FHA allowed people to apply for a 3-month forbearance on their mortgage, which meant that that they could actually skip their mortgage payments for 3 months, but all 4 months would be due payable. I think it ended up being at the end of August. Since then, we knew that that wasn't going to be the case, because if you can't make 1 mortgage payment each month, how are you going to make 4 mortgage payments in August, right? Didn't make sense. But they got that out there so fast, they didn't want to worry about the details of that sort of thing. They knew they'd figure that out later. So it allowed people to apply for this forbearance, which allowed for them to skip 3 mortgage payments essentially, and kind of worry about how it was going to be repaid later. Since then, it's been extended. But also since then, and really what happened was the industry found out, the same time buyers found out. It turned into this press conference that was basically unannounced in the middle of March. Here it is, you guys can do it. And investors just got inundated, and mortgage servicers got inundated with forbearance calls and requests. So since then, what ended up happening was that drove for a lot of different reasons. That drove, I don't know if you guys remember, but when FHA got really whacked hard out of the blue, that drove FHA's rates up like 2 points, and basically made it so that FHA wasn't available anymore. A lot of lenders overnight just stopped FHA loans. Additionally, what the ramifications have been since then is any loan that was, anybody that's in forbearance currently, we can do a loan for conventionally. But if you have a forbearance currently and maybe a mortgage late over the last 12 or 24 months or whatever, that may be something that gets you downgraded to decline. Kind of funny, but FHA, if you have somebody who's selling a home right now with FHA, they're in an FHA loan and they're in forbearance, and they're getting approved with a new loan, FHA, they actually can't, because they're according to the government, they're behind. They owe back federal liens, and so they're delinquent on federal debt, I should say. So they basically have to go through this whole process of getting out of the forbearance, paying it back, and it's still going to be extra hard for them, even when they do that, to get approved for an FHA loan, because the government is requiring the loan originator, the mortgage banker, to basically take responsibility for that loan if they go into forbearance again with a new loan. So it turned into this thing where people thought it was just free money falling out of the sky. And all right, great. It'd be one hell of a summer, right? I don't have to make any payments. My God, our vacation is going to be awesome. But there's some real issues there. So I would highly recommend that as part of your listing presentation to potential sellers, ask them, please, if they took advantage or if they're currently in forbearance. And if they are, and if it wouldn't crush them to get out of forbearance, I'd recommend that you recommend that they do that, because by the time they get pre-approved with their new lender, maybe the forbearance commentary isn't on the credit report, and that could make things a lot easier. Kind of getting off topic a little bit with forbearances and foreclosures, but that's really, really important. And just make sure that if they are in forbearance and they're already pre-approved, that you talk with their lender about whether or not there's any additional sort of layers that this forbearance is going to bring to their new loan once they do sell and find their new house down the road. Okay.
Thank you.
You're very welcome. Alicia, do you have any questions for the group or any questions for Jeff?
No, I can't thank you enough for coming on and such short notice as well to speak to the group about foreclosures. I know there were a few people that were really interested in the topic that weren't able to make it today. So I'm hoping we can get that recording and share it out with the rest of the office that wasn't able to make it on today. But just thank you so much, Jeff. I appreciate it. This is really helpful.
My pleasure, and because I am actually a very shy person and don't like to talk too much. So,
aren't we
if
all?
you have any questions? Yeah, you got to shut me up usually, so that's fine.
Oh, I love it. I love it.
Yeah.
I would love if any of the agents on the call had any questions. Unmute yourself, speak up. This is
And
a
I'm
great
available,
time to
so.
ask.
I have a
Ruth?
question.
Oh, there we go, Ruth. Yeah, go ahead.
This is Ruthie Dollar-Hyde. Why would the banks want to delay the foreclosure? What's the benefit to them to delaying it for so long?
Yeah, honestly, I don't know why they're doing it. There was a period of time I know where I think they felt some political pressure. You have a lot of particular lenders we've seen over the years that will have a large foreclosure base because of the types of loans they did back in the day countrywide with their no income, no verification loans. They were getting a lot of heat. Wells Fargo, as we all know, has gotten a lot of heat over, opening up bank accounts for people and stuff. That's part of it. I don't know financially, though, if there's other reasons. For example, can they write some of this stuff off? And also, given the recent litigation over the last, I'd say, 10 to 15 years, but really over the last few years especially, there's a lot where I think they're also looking to make sure that they have all the proper affidavits and all the proper information they need to foreclose. Because undoing a foreclosure is a nightmare for them. So, but I personally don't get it. I don't know why. I just know it happens on a very large scale. I still keep in touch with REO brokers, realtors, who just specialize just in the sale of REO, which, by the way, is not an easy job. You're often carrying, I know a firm that, a real estate firm that carried literally $500,000 to $1 million in costs regularly. They did a ton of foreclosures, but between all the money they owe their clean out people and their vendors and their plumbers and electricians, it was, it's quite an endeavor. But I think there's various reasons, and financial ones I don't know because I'm not in the industry enough to know why they keep postponing them. They'll set them up, but then they postpone them for on and on and on again.
I'd be shocked if the market conditions didn't have something to do with it. If we were seeing depreciation rates at 2, 3, 5, 10% a year, I really feel like they'd put a real priority on something like this. But when we have the kind of demand that we have, what's the rush, right? House prices are going up. So what's the rush? Not to say they don't want to get rid of them, don't want them off their books, but at the end of the day, what's the rush? If I
Could
sell
be,
it
maybe.
today, yeah.
Maybe if the loan has PMI, they're getting covered that way too. But
Yeah.
I'm assuming at some point the PMI policy has to say, listen, if you're in default, you get it foreclosed. We're not going to continue to make you whole as a lender, as the mortgage insurance company, unless you're also doing what you can do to get it foreclosed. But I just don't know.
Right. Jeff, do you know, or does anybody on the call have any current stats as far as foreclosures go? I think it's hard to be upside down on a mortgage today, really just because of the appreciation rates and because banks are not lending, even on second mortgages like they were back in the old days where you could get a home equity loan or line up to 100% of the house's value. Those kinds of things aren't as prevalent as they were back in 2003, 4, 5, and 6, 7, 8 even. But what are we looking at right now for current market conditions with active foreclosures?
My REO brokers do have a lot of inventory. Of course, they can't move it, but they do have a lot of inventory. And I used to keep that stat. I used to keep on top of that. But it's been years by going to Bankers and Tradesmen. Bankers and Tradesmen will tell you about all the new filings at the land court and how the numbers are. So I don't, again, I apologize, I don't know that answer, but if anyone's interested, if you go to Bankers and Tradesmen or know someone who has it, they'll tell you statistically what new filings there were for foreclosures. They do bankruptcy, they give you all those kinds of statistics on every monthly issue.
Got it. Thank you very much.
Yeah. Oh, one last thing. Anyone you're representing buying a foreclosed property, once these foreclosures start up, understand when you go to auction, if you're doing this for the first time as a buyer agent with a buyer, or you know someone who's going to buy a foreclosed property, remember, you buy that property subject to Title V, subject to tenancies, as is. You don't get to look at the property. When you buy foreclosed property, you don't necessarily get perfectly clean title. You get insurable title if there's a title defect. So there are risks in buying a foreclosed property if you're representing somebody. And what I also want to say is when you go to these auctions, you will be up against people whose living is to go to auctions. So if you're a person who says, oh, you know, I think I want to try to get a good deal and go buy a foreclosed property, and you go to the auction, 10 o'clock in Waltham, there's going to be an auction on 100 Main Street. You're going to see a group of people there who go to every auction every day. They actually travel the circuit. And it's actually deemed legal. There was litigation on this. They can actually signal, like do the nose thing to the other people that they're against. So there's, groups of people that buy these foreclosed properties. Instead of bidding against each other, they will at times say, I'll lay off and lay low on this and let you buy the property. And on the next one that I want, you give me a break and do it. So you're up against people who do this professionally. So you got to be careful there.
I think too, in working with somebody who on the buy side who's trying to buy a foreclosed property and knowing that it's not a lender like us on the other side, it's not typically a realtor like you guys on the other side, it's a bank, and that property is a file that sits on their desk that it's just a pain in their ass and they don't want to deal with. So you're working with someone who has no emotional vested interest aside from wanting this place to sell. So really, like, there's no back and forth. There's no, like, could we get a break on this, or could we get more time? Like, you're just dealing with a bank. So, and they don't care about you.
There's not much care level there. Yeah, you're right. Yeah.
How about pre-foreclosures? Maybe, you guys on the call here know, the Zillow pre-foreclosures out there. Is that just the 90-day notice? They're 90 days late, so officially for 120 days, the foreclosure process has somewhat started at that point. Is that when the pre-foreclosure listings kind of hit Zillow at that point? And do you know what that definition is? Anybody on the call?
My guess, sorry to chime in.
Yeah.
My guess is that they're probably going to the land court and looking at the foreclosure filings under Service Members Civil Relief Act. That's when they know someone's in trouble. That's the first public thing you can see is by going to the land court and seeing what actions have been filed there. And that's what Bankers and Tradesmen also picks up on, with filings there. And that'll give you an indication of, okay, so that's 100 Main Street, these people are in trouble, and maybe they can attack it that way.
I just, one thing about, I think that most of us on the call, all right, and there might be a few sociopaths here on the call. We're all psychopaths. We're in this business, but there's a few kind of, whatever, crazies in the call, maybe that would love to, earn their living through foreclosures, whatever. But at the end of the day, right now in this market, I really feel like there's a service to be provided to people who are lost in the foreclosure process, right? People who, let's say were laid off as part of COVID. And, the initial payroll protection stuff that the government was offering with the extra $600 a week or whatever, really made it so they could continue their mortgage payments. But since then, maybe things are getting tighter and tighter because maybe they're not going back to work. Maybe the $600 that's now turned into whatever it is, 2 or 3 or something, is fading away, and they don't see that light at the end of the tunnel. Their houses have never been worth, ever in history, more than they're worth right now. So even if they've missed a few mortgage payments, I really feel like you get that house in the market, you get all the equity that's due to you now, and maybe you rent for a year or two, then you can be pre-approved for that new mortgage, and you take that money that you got from the sale of your home and use that as the down payment, and you have the best of all worlds at that point, right? I just really feel like there's an opportunity to serve the client's best interests at a really high level right now if they are in a jam just because of the equity that we have. It's not like it was in 2008, 2009, where people are like, I'm getting foreclosed on. Oh yeah, and by the way, in order for me not to get foreclosed on and to sell my house, I'd have to bring 50 grand to the closing because I owe way more than my house is worth. So why the heck would I ever do that? Let's just let the bank take it over. Right now, for a lot of people, it's, I have equity in the home. I'm just stuck, you know, and I need somebody to help me, you know, realize what my options are. So I really do think there's a real opportunity for business there. It's an opportunity for you to serve your clients at a high level, come from contribution, which is important to KW, should be important to everybody. And at the same time, of course, help your family, help your business as well, right? So just something to keep in mind.
Jeff, can I add about when you said auction, because I have people ask me this, buyers, what is the process when you go to auction? When you go to an auction, it's not like buying a regular home, obviously.
Right.
So do you bring a certain amount of money to the auction as earnest money?
So in the notice of sale that's published in the newspaper, it'll tell you literally towards the 90% through the written notice, the publication, there'll be an item and it's underlined. It's called terms of sale. And it will tell you what, in terms of a deposit, you need to bring. And it will usually be a $5,000 or $10,000 bank check. And you have to bring that. And you have to be there before the auction because the auctioneer will then qualify you. And what they do is they take the check and they take your information. And that allows you to bid. But before you do that, before you take that step, the buyer should do their homework. As I said to you before, when you buy property at foreclosure, you buy it subject to Title V, whether it's a passing or failing, so you want to know, is it public sewer or Title V? You want to sort of get a sense, is there someone still living in a property? So maybe you do some drive-bys. You also take it subject to outstanding taxes and water and sewer, any municipal charges, electric charges if it's municipal electric. So you want to know, what am I getting myself into? And most foreclosures are of a first mortgage, which will wipe out the second, so you don't have to worry about that. But you definitely need some advice with someone who's familiar with foreclosures and familiar with the process, so you can understand the risk. The idea that you're going to buy a property at foreclosure and get the deal of the century is just a fantasy. It's not very common. Again, these guys that go out and do this professionally every day, I can tell you statistically, they will sometimes look at 30 to 50 properties before they'll buy one. A lot of times the banks bid the full debt, and there are instances where with all the accrued late payments or missing payments, the debt will actually exceed the value, and they'll do that so that the foreclosure is not challenged. So you got to do your homework because you buy it subject to all of those potential problems. It's not like buying a house in a conventional way, in a conventional purchase and sale agreement or offer. But to qualify, you have to bring a deposit, and that allows you to bid. And then if you're not the successful bidder, they give you the check back. And then they start the bidding. The foreclosure attorney has instructions from the lender on where to start, and the auctioneer does his or her thing. And they are full-blown auctioneers. They speak, the whole thing. So yeah, it's an interesting process.
I'll just say I actually did get involved with a buyer client, and that it did acquire a foreclosure, and that was through HUD. Maybe you had to do it online, submit your bid, and my understanding that process, they only take one bid at a time, and they either tell you if they accept it or they don't accept it.
Yeah.
So that was my one experience with the foreclosure, that we actually succeeded in getting the property.
Yeah, so that was when you were probably buying a property that was already foreclosed, then it went on the market. And the way they go on the market is sometimes they'll hire an agent like us, conventional agents, or they'll put it on an auction, but they own it already, but on an auction or a site where, like you had, Bill, where you had to go and they had to submit a certain paperwork and all that. And that's, God love you, because those can be brutal. I've reviewed those processes for, there's different companies out there to do them, and they're sometimes tough to read through, even just read through a lot of pages.
Yeah, no, it wasn't the smoothest process, but I think it also could have been a lot worse too.
Yeah.
Can you say something about marketable title versus insurable title in that regard?
Yep. So in any conventional purchase we do, whether we use a MAR form or a Greater Boston form, it is expected in layman's terms that when the buyer buys the property, but for the liens they're putting on, like the mortgage they're going to give the bank, but for easements, which are actually very common to utility companies and so on, they expect to have perfect title, right? That's what we all expect. With a bank, it's different. 99 out of 100 times when you sign a contract to buy a foreclosed property from a bank, if there is a title problem, and if the lender, foreclosing bank rather, can actually get title insurance to cover that problem, the typical contract in those instances says you still have to buy the property. Now, how could that be? Well, for example, remember, every time you sit at a closing, the buyer has to buy the lender a title insurance policy, right? Yeah. So we know on every foreclosure by a bank that bank has a title insurance policy from the day the mortgage was given back, right? For 50 years. So if there's a title problem that pre-exists the date the mortgage was given to the bank, the date the mortgage that's being foreclosed was given to the bank, we know that lender can easily get insurable title. They just go back to their title insurance company and say, there was a defective discharge from 10 years before we took this mortgage, or there's a defective deed. And the buyer will be required to move forward with that purchase. So good, clear record marketable title in lay terms is, I expect perfect title. Insurable title means there may be a title defect, but so long as the lender or the seller entity can get you title insurance to protect the buyer on that defect, you still must move forward. And that sounds good, and often it is. But there are some buyers in the future who may not want to buy that property because there's a title defect. They may not want to settle for merely insurable title. They want perfect title like most people expect. Very often that's a business decision. When you're dealing with a professional who actually goes and buys property at auction on a regular basis. I hope I was clear on that, didn't confuse the hell out of everybody.
And so perfect title is marketable title.
Correct. Yep. The language in paragraph 4 of every PNS says the seller will convey a good, clear record and marketable title.
Yep.
Subject to party wall agreements, easements, restrictions, reservations that affect the property so long as they don't materially interfere with the current use of the property as a single family or two family home and so on. But that's what the normal contracts we all have, whether it's the Mars form or the Greater Boston form. In any standard PNS, there's an expectation and a line that says good, clear record, marketable title, not merely insurable. But when you get into the purchase and sale agreements for an REO property, a bank-owned property, real estate-owned, REO, you're going to find more likely than not that so long as the lender can deliver insurable title, buyer, you're buying this house. Yeah.
Does anybody else have any questions right now about foreclosures at this point or the process? So if not, I have a burning question. All right, that it's going to be it's on a different topic, but you're an attorney, you're on this call. I need your help, Jeff. Okay.
Yeah.
So a little bit of a pet peeve of mine is that for something as important as the mortgage contingency in the purchase and sale agreement, right? The most important contract almost any of our clients are going to sign up, right?
And the most important clause in the contract. Yeah.
Yeah, it really is, right? So
it really is. Yeah.
I have to think that I've never been to law school, anything like that. I haven't even watched one episode of Law and Order ever. Okay.
What?
Yeah.
Never. Okay? Like
I feel like I'm essentially an attorney. No,
Okay.
no, not you, Jeff, but like due to Law and Order, I can represent any of you in a court of law.
Yeah.
Me too, Sam. Me too.
I'm more of a night court guy, but All right, so here's what I got, okay? I have to think that that mortgage contingency was created intentionally ambiguous, right? In an ambiguous way, because it's not clear. So if I have a client, right, who is buying $1 million home and they're applying for a $500,000 loan amount, that mortgage contingency basically states that if the buyer can't be approved for $500,000, they can withdraw from the transaction and get their money back. Which means, right? So this is the question that I have is I'm buying a house for $1 million. It's worth $1 million all day. The appraisal comes in at $600,000. Forget that. The appraisal comes in at $550,000. Okay. I, as a lender, can still approve that client for that mortgage financing, even though their terms are entirely different.
Oh boy.
Right.
Yeah.
But the buyers don't. But the buyer doesn't want it anymore, right? The buyer says the appraisal came in at $550,000. I'm not buying this house for $1 million.
Yeah.
I'm withdrawing from the transaction. What is that line there, Jeff? Because
wow. So I could do, well, honestly, I could do an hour on the mortgage contingency clause, which would actually be helpful for the brokers.
Yeah, we will do
should
that.
do
To answer your question, if all that clause says, if you have a property at $1 million and a person's applying for 600 grand, right? And it comes in, it appraises only at 900,000. You and I both know you can still give a loan.
All day.
Unless the contract says it's subject to appraised value.
Which most likely it won't in this market.
They have to buy the property or they're in default of the agreement. Now, if you are a broker negotiating a deal where you know your buyer has FHA financing, 97% financing, or 95% financing, do you need to make the deal contingent on appraised value? No. Because if it doesn't appraise, what's going to happen? You're going to be denied financing anyway. You're in the gray area zone, though, right? Where because the borrower is borrowing much less than maybe they're purchasing, or that gray area, 20% down maybe, it may not appraise, but they still may get a loan. They may have to get PMI, but the seller doesn't care. That's good. That's your problem. If I'm doing 80% finance, so I'm buying a house for $1 million and I'm going to borrow 800,000, but it comes in at 950. Well, now we know we've got not 80% financing to avoid PMI, maybe, but we have 85% financing. Well, you still get the loan, but you may have PMI. You still qualify. Buyer doesn't have the right to get out of the property. That's the gray area. That's the gray area we have.
So the fact that this buyer is so much stronger than my max financing borrower is really, at the end of the day, held against them.
Yeah, exactly. But there are certain buyers, whether it be $1 million buyer or $500,000 buyer, that may say, you know what, though, and we as the professionals in the industry, you got to remind people. Usually someone who makes an offer on a house, it's not the first house they saw. They usually beat the crap out of our Keller Williams folks, right? They've been driving around for 3 months, 6 months. They know what the house, they know that they're comfortable with that price. So a lot of people that run into that situation are fine still buying the property anyway. They think like, all right, the appraiser's crazy. I'm not crazy. I saw 40 houses. I was comfortable paying $1 million for this house. And it comes in at 950 or 900. I'm still comfortable doing it. So that is, yes, an area in the mortgage financing that you may still be required to purchase. If you still get the loan, you're required to purchase. It's only if you're denied financing. The other thing I want to point out to people is the financing contingency in a standard agreement doesn't give the buyer a right to extend. It doesn't, by the way, it doesn't give the buyer a right to extend. It gives the buyer a right to terminate and get their money back. Years ago, I had an old lawyer I sent out an email, and I said, or it was before emails, probably a letter saying, we didn't get our financing today. We're asking for an extension for a week or whatever. And the next day he contacted me, said, you're in default. And I said, what are you talking about? I sent out a letter to you. I told you. He said, you don't have a right to ask for an extension. He said, your letter needs to say that you want to terminate the deal and demand your money back. And the old-fashioned attorneys who smoke Luckies sort of remember that. That's what case law says too, that it doesn't give you a right to extend, it gives you a right to terminate. At the same time, you can ask for an extension. So sometimes when we send out those letters, we say, and by the way, if you don't give us this extension, this letter is being sent in our rightful election to terminate under paragraph 26 of the P&S and so There's a lot of confusion out there that people think, oh, the mortgage contingency clause opens up the ability to extend. No, it gives the ability to terminate the deal and kill it. And the significance of the mortgage contingency clause is if you do send out that letter, you could have a seller that says, that's great, I'm terminating because I no longer want to sell it to you, or I think it's worth more. I'm having, some regrets. I've had instances where we were going to send out extensions for a buyer, and the buyer said to me, no, don't do it. I'll take the risk because I know this seller is looking for a way out of this deal right now. It's rare, but we've had that happen. The other interesting aspect is that clause is one-sided. It exists only for the buyer to be able to terminate the deal. It doesn't exist that you have to prove to the seller you have financing.
And that's
as bizarre as that sounds.
Yeah, that's a big misunderstanding.
Yeah. So you don't, first of all, the seller has no right to really see the commitment letter. If you want to be gracious and give it to them and redact it, that's wonderful. But, it's as they say, whatever you say can be used against you. So you often don't do it. But it is a one-sided clause. It gives a buyer the right to get out of the deal and terminate and get their money back. It does not create a burden on the buyer to prove they actually have the commitment letter. Because once that day comes and goes, it's assumed they do, and the buyer assumes the risk on that.
And then on top of that, Jeff, just to piggyback on that, so let's say that we got a commitment letter and it was subject to 2019 W-2, right?
Yeah.
Just because that mortgage contingency or commitment letter was subject to a condition doesn't mean that if it's not met down the road, the day before the closing, you can tell the sellers, oh, we're now withdrawing from the transaction. We want our money back because their mortgage approval that I sent to you was subject to a W-2 that we didn't get and they're declined because of that. So once that date comes and goes, period, you're on the hook, right?
You're on the hook. And we always look, first of all, to get a spotless commitment letter is not common. They usually have conditions. So what we're looking for when we have a buyer with a commitment date, and we do this daily in this office, because we, as you, Bob, know, when I'm doing a contract, we calendar the date and offer on Outlook everyone to accept the date, but we do monitor for the client. It's the most important clause in the contract. I don't expect a clean commitment. What I want to know is, are the conditions doable? Are they simply getting a W-2 versus get naked, pour gasoline on yourself, and jump through a burning hoop? That's not doable. So if it's a condition outside the buyer's control, subject still to appraisal and so on, then we ask for an extension. You have to. If it's a condition that is within grasp, the buyer still has to use good faith and fair dealings to move forward and get that secured financing. They can't look for a reason not to. So
can I clarify something that I just, in summary, I think I heard this correctly. So if it's a buyer that's going, like, say, with an FHA loan and they're, mortgaging the majority of the loan, it's not, in this competitive market, it's not a good idea to throw on that additional statement subject to bank appraisal. Versus if they're going, say, with a conventional loan and they're putting down 20% or whatever, then it would be a good idea in terms of representing a buyer to have that language on the offer. Do I get that right?
Yeah. Yeah. If it's a gray area where they could still possibly get the loan, but they wouldn't buy it if it didn't appraise, then you want that language in there.
Okay.
Yeah.
Gotcha.
You may not get the property, but you have that language in there.
I mean, and could you, Jeff, would you recommend if, the appraisal flag, and you don't want to, do anything underhanded, but at the end of the day too, you still want to represent your clients and protect their interests the best you can.
Yeah.
You could, in the mortgage contingency, basically throw in a de facto appraisal condition where it's subject to buyer financing $500,000 at a 50% loan to value or something like that, right?
Yeah.
Then in that point, if I am the lender and we can still approve that person, but because the appraisal came in way lower, it's not at a 50% loan to value anymore, or whatever it was I just said, it's now at a 60 or 70 or 80 or whatever. Now they can't get those terms. So is that something you would talk with somebody?
I've never done it. I've never put the loan to value ratio in the clause. You could, but I think what's done in lieu of that is making it subject to appraised value.
Yeah, right.
That even if you could still get the loan, you're not going to buy the property. But as Bill, just going back to what Bill said, again, for the most part, I think we'd all agree that most of the people you represent on the buy side, again, have not looked at, that's not always the case, but this isn't the only house they've looked at. They've looked at 30, 40, 50 houses, and they're comfortable with that price. I just had a client, not to, again, drag this thing on, I just had a client that's a high-end home, say, listen, the appraisal said the house was 5,100 square feet. The seller represented was 5,300 square feet. What should I do? And I said, you should buy the house. Well, it's 200 square feet, price per square foot. And I said, this isn't a price per square foot equation. This is, I want to buy this house equation. You've seen a bunch of houses. It's not, first of all, grossly off on the numbers. But I assume when you're paying 1.7 million, whatever this house was for, you've seen a bunch of houses and you're comfortable with that house at that price you paid, even if it doesn't appraise, even if there's a discrepancy on the square footage. And he said, you know what, you're right. So, but yeah, I think you would put the appraised value clause. The problem I always have with the appraised value clause is, and I don't know the answer, we all know the appraisers look at these P&S agreements. And are they looking at that saying, I wonder why they're all putting this here? Does everyone sort of agree that this isn't really what it's worth? So I don't particularly like the clauses, but I can understand if people have them, and then if it's in the offer, I got to put them in the P&S.
Right. So, you know, in the sake of time, I think we could go on. I mean, this has really just been awesome. It's tough. It's too bad that we have to, you know, kind of end here, but we can always continue this, guys. For the people that are on the call, if you'd like to have Jeff back on some of these calls and talk more about the mortgage contingency, the foreclosure process, the title process in general, and how that works, let Alicia know. Really, any topics that you guys want to talk about, let Alicia know. We just, you know, otherwise we're just going to make up topics and hope you guys find it. Okay.
We actually just got in the chat a suggestion to have Jeff back on to speak more about mortgage contingencies from a couple of the agents. If
Awesome.
That's something you're interested in, Jeff.
I am. I'd love to speak to folks. So let me tell you, I'd love to speak to folks about sale of home contingencies. Sale of home contingencies or suitable housing contingencies, and how as a broker to avoid them and sort of not push your clients, buyer or seller, into doing a deal, but really putting realistic clauses in a contract to get a deal done. Again, I'm not into pushing people, but sale of home contingency or subject to suitable housing contingencies, there's language I have in certain deals that I think really work. There's language I see out there, especially on the Mars form, that I think is dangerous. And you and I all know, whenever you have a deal and someone signs an offer, I don't care if it's subject to suitable housing or subject to selling a home, there's an expectation buyer and seller think they're just going to buy the property, and anything that can undo that deal, people just don't put their mindset around it. But I could, guys, like I said, I could talk to you about any topic you want. Let me know.
Awesome. All right, well, we'll connect with Jeff after this call and see if he's available for next week to discuss contingencies.
And in the meantime, guys, I do have Jeff's contact information in the chat here too to everybody. So you have it, copy it, paste it, whatever you have to do, take a picture of it, and reach out to him if he can help your buyers, your sellers with any of their title needs. Okay, guys?
Perfect.
Thanks, guys.
Thank you.
Thanks, Jeff. Good to see you.
Bye,
Thank
guys.
you so much.
Thank you, everyone.